I think this so far was the most important day of the year because for the first time we really introduced an economic possibility that so far we had generally been able to ignore, and that is a true stagflationary environment. There was so much going on from earnings to Powell, but the absolute most important thing we got today was an ISM print that continued to worsen. It's a bad mix that we've gotten now for two readings. First, it was the manufacturing slipping back under 50, and then it was today where prices paid exploded to almost 61, while new orders were below 50. There was a 12-point spread in ISM that is literally what stagflation looks like. Contraction on the economy, sticky and rising inflation. So far, over the last 2 years, we've mostly been thinking about whether or not we're in Goldilocks or a kind of purgatory. This is the third outcome that is the least desirable. So the first thing I need to change on my risk radar is actually bonds. This might sound a little surprising because today Jerome Powell basically took cuts off the table for anything in the visible future. He notably, of course, didn't put hikes back on the table, but my bond red light I think needs to go yellow for the moment, because if we get any more data points like the last two we got from ISM and the previous manufacturing, that's a scenario where even if there is inflation, it may not mean higher yields if the economy buckles. Now, I've been in the camp for months, really for the better part of the last 2 years, that inflation and higher yields has been the better outcome because they've been reflecting a stronger than expected economy. I've talked a lot about the 10s to the 2s spread. After last year's bear steepening, the yield curve widened out, and now for about the last 5 months, it's been going sideways. And to me, that has told me that inflation, even though it's a problem, is a problem that we'd prefer because it means growth is staying elevated. But if these prints start to turn sour and it looks like stagflation, then the yield curve might contract again. If that combination of growth and inflation turns unfavorable, and even though today didn't look like we responded to that ISM, actually, if you take a real close look at the curve, we did. This was the candle this morning that we hit right as the number came out. Okay, so this is contraction. Same thing as we got data in the morning. These are the 10s and the 2s. We got big red candles, flattening of the yield curve. So I think the market did notice how important that was. But then Powell came and tried to soften things up, and then we got that yield curve widening out back again, which is a healthier sign. So you want to continue to watch this chart. Don't ignore the 10s and the 2s. I know a lot of people think it's cool to ignore it, but it's not. It's actually been a really great tell. Now, the dollar I'm not changing yet on the risk radar because you saw the dollar firm up when stocks came off. Stagflation should be very bad for stocks. However, bonds up for grabs, dollar up for grabs. And so right now you're seeing the dollar catches that bid when stocks come off. That could keep the dollar elevated. A stagflationary environment, in theory, would be bad for the dollar over the long term, but if the Fed actually doesn't cut to combat slowing growth and the stock market gets hit, the dollar might catch a bid. So that's why I'm just changing bonds for now on the macro front. Also, by the way, we're up at the one-year highs, and we've already seen some sideways movement here in the last 10 days for both these assets. So that's why bonds go yellow for the moment. The dollar stays green. But there is one more change, and it's crypto. Remember, my yellow light actually has been there while stocks have been red because the semiconductor breakdown, I think, was more of a clear sign that stocks were going to roll over. But Bitcoin had been holding its levels even though it was weak and peaked at the same time as the tech momentum trade. It was until really the last 48 hours that Bitcoin really broke here. BTC now cutting below 60K. The difference now between Bitcoin and actually the chips is that the chip chart found a higher low here in the last 3 weeks, but Bitcoin just cut below last month's low. So that's why my light for crypto has to go red, because it's now trending lower as Bitcoin, the leader of the group, drops below last month's low. The other reason why it's red is because the long-term chart that I pointed out before, I've argued is making an ascending wedge on the long term for Bitcoin, which basically means each time it's tried to break out to a new higher high, it's fizzled faster. Look at the way we couldn't get far past the old high in the upper 60s. The relative strength at Bitcoin's successive highs has been decreasing, and to me, that is like the ultimate bear case for something that is a purely speculative asset looking like it's running out of buyers. This was a big day. Crypto got pushed to the bottom of the pack. Stocks failed to rally back. We got the most clearly stagflationary print we've seen in years, and Powell didn't seem like he had a lot of answers. This should be a fun rest of the week. Have a good night.